DCB Bank Limited's quarter 2 fiscal year 2026 results are finally out. So let's check how were these results. Okay. So first we have the interest income. Okay. Interest income is the income it received as interest on all the loans it gave out. Because it's a bank, of course. It increased from 1,568 crores in quarter 2 fiscal year 2025 to 1,823 crores in quarter 2 fiscal year 2026. So 1,568 crores to 1,823 crores, you can regard interest income as the revenue of a bank. For a bank, the revenue. Interest expense, the interest it gave out on deposits of the bank, all the depositors, increased from 1,059 crores to 1,227 crores. So interest income minus interest expense gives us the net interest income or the NII for the bank, which grew by 17% year on year from 509 crores to 596 crores. Then other income, non-interest income, actually declined from 205 crores to 186 crores. But but a good thing here, positive line here, is that the core income, the commission, exchange, and brokerage income, this is the core fee income, the core non-interest income for the bank increased from 139 crores to 158 crores. So really nice increase for the core fee income, which is considered as the more sustainable income for the bank, non-interest income for bank. So total income increased by 10%. Okay. Operating expenses increased by an impressive only 4% increase in operating expense. This very low increase in operating expense led to operating profit increasing by 19% year on year. The provisions and contingencies. What are provisions and contingencies? Funds set aside for a specific reason, like funds set aside to cover loans that have gone bad. That is one type of provisions. It also increased by 33%. And despite this provisions and contingencies increased, net profit before tax increased by 16% and profit after tax increased by a nice 18%. So NII did very well. Just profit and loss on sale of investments declined from 52 to 23 crores. This is a less sustainable source of income because you cannot always be selling investments and all. But still, to note it down, other income did increase and core income like commissions, exchange, and brokerage income did increase for the bank. And they are making more provisions, which is not the worst thing. Then the total balance sheet advances plus deposits increased by 14.41%. Okay, interesting. Advances increased by 19%. Total amount of loans given out increased by 19%. Deposits increased by 18.79%. Then NPA, non-performing assets, the percentage of total loans that went bad, meaning the borrowers are unable to pay back, declined from 3.29% to 2.9%. The lower this percentage, the better. But the net NPAs, the non-performing assets left after provisions, okay, after provisions, it actually increased from 1.17% to 1.21%. This is something to be kept an eye on if net NPAs will increase or not. And provision coverage ratio, which is, I believe, total number of provisions upon total number of loans that have gone bad. So provisions is a numerator, number of loans gone bad, denominator, comfortable 74.15%, comfortable. Then, nice capital adequacy ratio, very important statistic, increased to 16.41%, comfortable, nice, W. But the current account and savings account increased from 25.6 to 23.5, which is not a good thing. Okay. Higher number of current account and savings accounts as the total number of deposits means less interest expense for banks because current account and savings accounts have really low interest rates to pay. So net NPAs is a thing to keep an eye on, and current account savings account is a thing to be kept an eye on. So let's see if they actually are doing good or not. Okay, two things to keep an eye on in the future. Now, head count, total number of employees, they were actually able to decrease from 11,910 to 10,792 people. Okay, so despite that decrease, they were actually able to increase sales. So per person sales must have increased. Branches have increased to 448 from 451. You can see the concentration. You can see the colors and where the concentration is. Hold up. 16% is Maharashtra, 19% is in Delhi. I think that's Delhi. 19% is it Gujarat or Delhi? I'm not sure. And then you can see where are the branches highly penetrating or where are the branches not highly penetrating. Then funding mix. You see this funding mix, where's the money coming from? Pay attention to these colors, especially the current account and savings account. As we discussed earlier, 21.5. Let's see if they can increase this. And of course, 70% of its funding, money it lends out for loans. Where is it getting the money from? Came from term deposits of the people. Then we move on to this. Gross NPAs have seen a nice decline. Net NPAs more or less stable. Slippages, number of loans that are going bad, 3.17%. Lower this, the better. So it seems to be on a, it's somewhere around there only. Stable slippages. Slippages excluding gold loans is of course lower, but 2.5 pretty stable, albeit a bit higher. Credit cost 0.31 increase from 0.27. Okay. Provision coverage, a bit of a decline, but still comfortable. And excluding technical write-off, a stark decline. So, yeah, I think I should actually tell what technical write-off actually means. Then the yield on advances 11.11%, bit of a decline, but cost of funds, cost of deposits, both also took a bit of a decline. So, not the worst. In net interest margin, NIM remained stable at 3.23%, a slight decline from 3.27% to 12 months back, but okay. One good W, return on equity increased to 13.2%. 13.2% return on equity, which is great. Then return on assets 0.94%, a slight increase from last time's 0.93. Cost to income ratio, which is the cost as in the operating expenses like paying employees and salaries and all that. Okay, all of that 61.15. Lower this the better. So nice decrease from 64.26, 61.15, but a reversal from quarter one. But year on year, it has done well. And what is this? Cost to average assets. Again, lower this metric the better. So a nice decrease in the cost to average assets. So the cost must have not increased that much, and the assets must have been increasing a lot. But because the assets is the denominator, so assets increasing a lot, cost not increasing by that much, nice decline to cost to average assets. And finally, what else to show? There's only one thing to show are the targets. Yes, the bank's targets, the aim of the bank. Now, the aim of the bank is to first double its balance sheet every 3 to 4 years. Okay, they want to have the net interest margin 3.5 to 3.65%. Currently, is 3.23. Then they want to have the NPAs, non performing assets, gross non performing assets 2.5% below. Net NPAs below 1%. Currently, it's 1.21%. So, there are some things to work towards. They want their credit cost to be 0.45 to 0.55%. Okay. Then they want their income ratio, cost to income below 60%. This quarter was, I think, almost there, slightly higher than 60%. Cost to average assets 2.5 to 2.6. I think they did better here. They reached like 2.3. Return on assets, they want to have about 1%. They reached around 0.94. And return on equity, they want to reach around 14% by their own calculations. By their own calculations, they've reached around 13.2%. 2% right now. So that is it.